Sooner or later, every successful company hits this massive, decade-defining question. They've got a great idea, but should they actually build it? Today, we're going to dive into the frameworks that help separate a brilliant move from a really costly mistake.
Okay, so picture this. Your team comes up with what feels like a game-changing idea. A new factory, some revolutionary software, maybe a whole new business venture. The energy in the room is electric, right? The potential feels huge, but let's be real, so do the costs and the risks. So how do you go from that great idea feeling to making a truly smart decision? Well, to answer that, we've got to get on the same page with our terms. We're talking about something called a capital project, and once you really get what that is, you'll see the core dilemma that every single business has to solve.
So what is a capital project anyway? At its heart, it's pretty simple. It's any venture where you spend a chunk of money now to create or improve something, an asset, that will hopefully make you even more money down the road. That's the whole ballgame.
And look, we're not just talking about big buildings here. Yeah, it could be a new factory for sure, but it could also be launching a brand new business, completely overhauling a critical computer system, or redeveloping a piece of property. The common thread is always the same: spend money now to get returns later.
And this brings us to the single most important rule of the game. It is absolutely fundamental. The money you make from the project must be more than what it cost you to get the money in the first place. Think about it. If your project cost you 10% to finance, it had better make more than 10%. If it doesn't, you're not creating value, you're literally destroying it.
Now, you might think companies just jump straight into some super complex spreadsheets. But nope. Before any of that happens, there's a really vital first step. Think of it like a common-sense gut check. It's called the initial appraisal.
And the whole point of this initial check is just to be a filter. I mean, detailed financial modeling is expensive and takes a ton of time. This first pass is designed to weed out the non-starters, you know? It saves everyone from wasting a lot of effort on projects that were just never going to fly.
And one of the biggest things they're looking at in that first check is risk. You can see it visualized pretty clearly here. A low-risk project has this tight, predictable range of outcomes. You're pretty sure what you're going to get. A high-risk project. Wow, I mean, the possibilities are all over the map, from a massive success to a total failure.
And here's the thing, that risk has a price tag. It translates directly into cost. So if a bank offers one entrepreneur a loan at 10% and another one a loan at 15%, it's not personal. The bank just sees that second project as being a lot riskier, and they charge a higher interest rate to compensate for all that uncertainty.
But you know, it's not just about the risk and the potential return. This initial appraisal asks other really big questions. Like, does this project even make sense for us? Does it fit our overall strategy? Will it get the support it needs from senior management? And maybe the biggest one of all, we have limited money and people. So is this project the absolute best use of our resources right now?
Okay, so let's say a project passes that initial sniff test. It seems like a good idea. Now it's time to open up the financial toolkit and get really serious about the numbers.
Now, there are a lot of ways to evaluate a project, but they almost always boil down to three core methods: net present value, which we'll call NPV, internal rate of return, or IRR, and the payback period.
So, the one most people consider the gold standard is net present value. The idea here is simple but incredibly powerful. A dollar tomorrow is worth less than a dollar today, right? So what NPV does is it takes all the future cash you think the project will generate, it discounts it to figure out what it's worth in today's money, and then you subtract the initial cost. If that final number is positive, boom, the project adds value to the company.
Then you've got the internal rate of return. IRR kind of flips the question around. Instead of asking, what's the value in today's dollars, it asks, what is this project's effective interest rate? It's the exact discount rate where the project breaks even, where that NPV is zero. Then you just compare that rate to your cost of capital. Simple.
Now, the big plus for IRR is that managers tend to love it. A percentage return is just really intuitive and easy to grasp. The problem, well, with more complex projects, say one with a big cost midway through, IRR can sometimes produce multiple answers, or even results that are just plain nonsense. So you've got to be a little careful with it. And the simplest tool in the kit is definitely the payback period. This method basically ignores all that time value of money stuff and just asks one question: how quickly do we get our initial investment back? And for smaller companies where cash is king, knowing you'll get your money back in 18 months instead of 3 years, that might be the most important metric of all.
Okay, theory is great, but let's actually see how this works in practice. We're going to walk through a really quick example of an NPV calculation.
So let's meet our test company, Wrong Turn Limited. They're looking at a new project, and it's going to cost them $4 million right up front. The big question is it actually worth it?
Here's how they'd figure it out using NPV. First, you map out the cash flows. That's minus $4 million today, a positive $2 million in a year, and another plus $4 million in 2 years. Second, they set their discount rate, or hurdle rate. That's the minimum return they'll accept, at 20%. Third, they discount those future cash flows back to their present value. And finally, they sum it all up.
And the result? A positive net present value of $440,000. The project clears the hurdle. So, according to the spreadsheet, this is a green light. This project is going to create value for the company.
But here's the twist. The decision is never just about the spreadsheet. You have to look beyond the raw calculation, because that's where the human element and the real art of business actually comes in.
Yeah, there's a much broader way of looking at it, sometimes called the shareholder value approach. It zooms out to ask these much bigger questions. It's not just about cash flow in a vacuum. It's about how the whole world, investors, competitors, analysts, is going to see this move. Does it make us look innovative, or does it make us look desperate? Does this decision align with our company's story?
And all of this, it leads to the final verdict. You see, the process isn't some simple formula. It's a blend of really rigorous financial analysis and, well, strategic judgment.
Which leaves us with a final question for you to think about. When the stakes are high, when a huge decision is on the table, what do you ultimately trust more? The precise calculations on the spreadsheet or the long-term vision of your strategy? The best answer, of course, is finding a careful balance of both.